In this week's update, time for investors to rethink their approach. Are quality growth stocks overvalued? Is silver starting its run? My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Okay, let's look at American stocks. It was another very positive week, and the S&P rose 3.5%. The Nasdaq did even better thanks to the FANG stocks and the other big tech stocks. Nasdaq up 6% on the week. Just an amazing continuation of the recovery. The S&P is now consolidating under resistance, so we'll take a look at that and the Nasdaq chart as well. So I think we've reached a point where the market is probably, maybe just consolidate here. It's hard to see what's going to cause the market to pull back by any sort of significant amount. We might see a 3 to 5% pullback, but it's pretty hard to envisage anything much more than that at the moment. Now, the US lost 20 million jobs so far, and you would think the market would be absolutely crashing as a consequence. Well, that's nearly 15% unemployment. But the market is looking past that. It's looking to better times. It's still conjecture yet whether that is the correct view or not, but look, it is what it is. It's what the market is doing, and it's very tradable and it's very profitable. So you just go with what the market is offering you. The other point about particularly the American market is that there is a huge bifurcation between different sectors. We're seeing enormous divergences in price performance. And it gets back to something that is a bit hard for the human psyche to naturally do, and that is, to buy strength. And it happens in the US more than it happens here for some reason. I don't understand why, but the American market seems much happier to buy breakouts and pay up for the leading stocks. The stocks that are winning seem to get more and more attention from the fund managers than they do here. So the leaders are leading for a reason, and the main reason is that they're showing enormous sales and earnings growth. Over the last month or two during this global lockdown, we've seen some stunning increases in sales revenue and earnings for a lot of the technology stocks. It's been quite surprising, and in fact, the top 5 of the big tech stocks in the S&P, which make up 22% of the S&P index, have actually seen their sales rise by 14% year on year for the quarter. And that is during a period where effectively the world is shut down. But of course, it's not for some companies. Now, the other point I want to make is that now that we've had this amazing rebound and people are questioning, earnings are going to go down, and so therefore the PE ratios are going to go through the roof. And what this argument is completely missing is just the reality of how market pricing and valuations work. And I'll come to that towards the end of this video. But I just want to make the point that the people that are making a lot of noise about PE ratios are too high and stocks are overvalued is just a complete nonsense. So just try and ignore it, because it's really throwing you off the track of some amazing opportunities. And I'm talking for the best stocks there. So for a lot of the market, that PE observation is valid, but it is not valid for the whole market, that's for sure. Now, the US dollar went higher to 99.73, up about a cent on the week, and the 10-year yield again was steady, and the cash rate is effectively zero. All right, let's jump in and take a look at some charts. So this is the S&P. As we've been looking, this is the 20-day moving average, the green line. The blue line is the 50-day moving average, and of course the red line is the 200-day. The S&P has managed to rebound to the 61.8% Fibonacci retracement level. So that's the retracement of the whole crash from mid-February down to the lows in March. We had a dip, but the support of the 20-day moving average held, and that's a real sign of strength. The fact that the 20-day moving average is now providing support. That's a sign of tremendous strength. But as I indicated a few minutes ago, a lot of that is because the top 5 stocks, which is basically Amazon and Facebook and Apple and Microsoft, are just doing so well, and Netflix. So they're really sort of carrying the day a little bit. There's a lot of parts of the American market that aren't nearly as robust as this. So I suspect we're going to see some consolidation in this area. If we can break above the 200-day moving average, then that would be absolutely enormous, because that would bring in a lot more technical buying. So that's probably a pretty important level to watch as well. So that's the S&P. Let's just look at the NASDAQ. So you can see the NASDAQ in relation to its retracement, there's the 61.8%. It's gone way past that, and it's getting back towards its all-time highs. And you can see the outperformance of the NASDAQ compared to the S&P in this bottom window down here. And of course, outperformance draws in more fund managers. You know, you can't dismiss the importance of that factor. US fund managers cannot afford to be in sectors or stocks that are not outperforming the S&P general index, because if they do for any length of time, then they're going to lose money. Funds are going to flow out of their fund and go into another fund that is outperforming the S&P. So do not underestimate the importance of outperformance, and that's why strength begets more strength. And you know, people in this market who are trying to pick the bottoms, you know, that want to buy beaten down travel stocks or beaten down airline stocks or building stocks, you're just on the wrong train altogether. You're absolutely flogging a dead horse trying to pick the out of favour stocks. You know, buy strength, because it's going to lead to more strength. Very, very important point. All right, let's look at the American dollar. So not a lot of change there, and we've really got this fairly tight consolidation, which is happening in the US dollar at the moment. So we're getting a wedge formation playing out here. We will get a break one way or the other, and at the moment, I really have no opinion as to which way that might break. And the Australian dollar is showing strength. Now, the Australian dollar is showing strength, and that's a good sign for commodity prices. It's also a sign that some perhaps overseas money is buying into our stock market as well. That can also, of course, help push up the Australian dollar. The other point in the US too is that amazingly the yield curve is steepening. Now, what that means is that the longer dated yields, so the 10-year and the 30-year yields, are rising, whereas the short-term yields, the 6-month and the 1-year and the 2-year yields, are not rising. So the gap between the long end of the bond market curve and the short end of the bond market curve is widening. So the yield curve is getting steeper, and what that is pointing to, amazingly, is better economic times. Now, there is no logic in that whatsoever, but that goes to the point that I've been making now for years, that if you try and attack this market on the basis of logic and what should be, then you're going to be very sadly left behind. You've got to pay a significant amount of attention to what the price action is doing, because often it defies logic as we would understand it today. And the reason why the market moves up now against logic becomes apparent in 3 months, 6 months, or 12 months' time. And you look back and you go, that's why that was happening. So very, very important to be guided by the market and not by what you think. Turning to Aussie stocks, our dollar was higher again, as we just saw, and that's a pretty good indicator for commodities longer term. And that fits with my expectation that we're going to go into perhaps a golden period. The final part of the long-term economic cycle often ends with a commodity price boom, an economic boom, a rise in inflation, and that all fits. And I think there's a very, very good likelihood that that's the environment we're going to be in for the next 5 years. Now, I know a lot of people are sort of forecasting, a lot of commentators are making the case for deflation. I wouldn't be surprised if we finally get a fair dose of inflation. Now, the ASX 200 rose by 3.4% on the week, and as I've been saying since the crash hit the bottom, the money would flow initially into the large cap stocks and then would filter its way down. The small caps wouldn't get any love for a while, but that now is starting to happen. And the small cap, the quality small cap growth end of the market is really starting to pick up steam about, what are we, about 7 weeks after the lows of the crash. So clearly fund managers are now moving up the risk curve. They're now putting more money to work, and they're putting it to work in some of these smaller growth stocks. In the portfolios, in the services that I have, the Insiders Club and Portfolio Analysts, there were numerous 30 to 50% gainers last week in those two portfolios. So an exceptional week of gains. However, we've got several sectors that are clearly back into bull market conditions, but a lot of stocks are being driven by liquidity, not by an earnings recovery. Now, some stocks are being driven by ongoing strong earnings. The earnings never faltered during the crash, but there are many stocks that are rising that shouldn't be because it's just liquidity, and they're the dangerous ones. So they're the ones that we need to try and avoid. My overwhelming recommendation is that you need to be more active in this market. You need to buy weakness, buy modest pullbacks in great stocks. They're probably not going to be much. You might only get 3 or 5%. But if you're buying into those modest pullbacks, then take some profit into strength. Don't push your luck too far. Keep turning it over, and if you just keep doing that, keep focusing on buying some weakness, selling to strength, and then just repeat that process over and over, then I think you'll be in good shape. Now, I just want to look at the Australian indices. So we'll start first of all with the ASX 200. And again, I just want to run through all the sectors just to show you the relativity against this percentage rebound. So remember, the S&P was up here in relative terms. The NASDAQ was up here in relative terms. The ASX 200, which is being dragged down, of course, by the banks and a number of other big old world dividend-paying stocks, is still struggling to break through even the 50-day moving average. Let's look at why. Energy is down, but it has recovered to a degree. Banks are way down. They've not been able to get anywhere near the 38.2% level. And I wouldn't be surprised as more and more people start to change their thinking about owning the big four banks for the dividend, because the dividends have either been cut, suspended, deferred, whatever it is that's going to happen, that we could see another leg down in the bank valuations. So not only are you missing out on the dividends that you thought you were getting, but you're getting beaten up on the capital side as well. So not a good scenario for the banks. There's healthcare. They've obviously done pretty well. There is the materials. So material sectors, so BHP and Rio, etc., Fortescue, they've moved up to the 50, done a little pullback and starting to move up again. So they're stronger than the rest of the market. But small caps, you can see just how well the small caps did last week, and how sharply they've improved from the lows. So there certainly are some good parts of the Australian market that you're entitled to be participating in. Now, let me just give you a precious metals update. In my view, gold equities are far lower risk than most of the rest of the market, so other general non-gold stocks, because most of the market really can't forecast their future earnings and cash flows, whereas gold stocks can. They know what their price is, they know what their costs are, They know what their selling price is, and there is basically an unmet demand. So the forecast future earnings and cash flows of gold miners are absolutely crystal clear. And you can't say that about much of the rest of the market. So therefore, that has to be lower risk, in my opinion. Plus, what happens if there are more financial shocks? What happens if, as the economies around the world start to get opened up again, that we don't get a resurgence in virus outbreaks, and therefore restrictions have to be reimposed? So there is risk of more financial shocks. That won't affect gold stocks at all. In fact, it would be a tailwind for them. So gold stocks earnings are very clear, and they're rising. As gold goes up, obviously the earnings are going up. But also the costs are falling for gold stocks. I think this is a point that's being missed by a lot of the market. Particularly energy and consumable costs are going down. You know, energy costs have dropped obviously a long way, and labour costs are going down as well. So the gold sector has the highest rate of earnings per share growth in the last quarter of any sector, and I'm talking in America here. So this was an American study that I was looking at. So the highest rate of earnings growth of any sector in the US market. The long-term profit picture for gold miners is really stunning. So that's the potential profit. But the second part of that equation is how likely is that potential to be realised? And I believe it's highly likely that that potential is going to be realised. So it's hard not to be excited about the precious metals sector at the moment. And I think the penny is increasingly dropping, with central banks are building up this incredible debt pile. It's just completely astronomical. And I can remember 2 or 3 years ago when people were saying, how will we ever wind back the debt levels that they had in 2017 and 2018? Well, look at them now. Some of them are approaching double or triple the levels we were at just a few years ago. So there's almost no chance that these debt piles can be wound back to where they were before the GFC. So central banks are between the proverbial rock and the very, very hard place at the moment. And when you look at it logically, the only way forward for central banks and for governments to get out of this mess is to debase currencies. There really is no other long-term solution to getting out of here. So I think we're going to have negative real interest rates. So that's the nominal rate less inflation. So we're certainly on negative real interest rates at the moment, even though inflation is low. But if inflation starts to tick up, which I think you can build a pretty good case for that, then real negative interest rates are going to be around for a long time to come. And that equates to wealth destruction on an absolutely grand scale. And that's why a lot of the emphasis of this week's video is to try and get investors that have done things the traditional way, that have relied on dividends, and not sort of worried too much about the capital value fluctuations, to really think hard about strategy and their approach, because where things are heading at the moment, it's not going in a very good direction for those that are using the older kind of investing practices. I'm sorry, I hate to say that, and I know that that'll be a concern for a lot of retirees, but you've just got to acknowledge that the world has changed, and it's probably not going back to where it was. Bonds and stocks in general have got huge question marks over them. You can't deny that that's the case. The bond market is got some potentially rocky times ahead. But gold doesn't. It's the one sector that doesn't have a question mark over it. It's crystal clear where the profits and the cash flows in the future are going. So gold provides the obvious alternative, either as a hedge or as a straight out investment for capital gain. And there really isn't any other asset class that you can point to that has got the clarity around future earnings and cash flows. And the final point on this is that nearly every fund in the world is hopelessly underweight this sector, which happens to be the outperforming sector. So come back to what I said earlier about particularly US fund managers cannot afford to be lagging the rest of the market. They just have all their funds ripped away from them. So why wouldn't funds as gold and gold stocks start to outperform and silver stocks start to outperform? Why won't funds be forced into changing their weighting? And they're hopelessly underweight. So I'm extremely bullish about the sector. Just a point on the gold price dynamics, because there's all sorts of unexpected things happening in the gold market. In fact, in all commodities markets at the moment, there's actually been a supply shortfall in the supply of physical gold, and that's because some gold refineries around the world have been shut down because of the virus. So what that has caused the prices in the futures market to rise to an incredibly large premium that got as high as $70. So some of the futures contracts were priced at up to $70 higher than the spot gold price. And what that is doing is it's actually helping to drag up the spot gold price because of the dynamics of how that interplay works between the futures market and the spot market. And the final point I want to make on this is that those who think the gold price is simply a function of the US dollar, you need to look again, because there are 4 or 5 really strong drivers of the gold price, one of which is the US dollar. But it's not the only one. It is not as simple as US dollar up, gold down, and vice versa. That's just far too simplistic a way to look at things. So let's jump in and take a look at those markets, the precious metals markets. There's the gold price for the week, so still maintaining this very steep uptrending channel, and it was effectively unchanged in a smaller range last week. If we look at the dailies, you can see really just heading sideways on the week, but we did see the stocks start to outperform. So I talked about that last week, the fact that silver was lagging gold, the fact that GDX was lagging gold. Well, we got some correction in that situation in the week just gone. So let's look then at silver. So it's not much, and it really only happened on the last 2 days, but the last 2 days silver was materially stronger than gold was. And if we look at this relative strength spread, so this is the spread I've been looking at over the last few weeks. So it reached an extreme in the middle of March, but you can see that we certainly did get a turn down. So in other words, silver, the fact that this is turning down means that silver was outperforming gold in the last week. And if we look at GDX, it continued this really nice breakout, and this was a very important breakout for GDX, which went all the way back to 2013. So this is a 7-year base. We've broken out, and GDX is well and truly on its way. So a lot of very, very good things happening, and look at the outperformance of GDX relative to the S&P down the bottom. And remember, this is on a weekly basis as well. Okay, so gold just up $2, finished at 1704, and silver also starting to look better. GDX was certainly one of the strongest sectors of any asset class, not just stocks. And similar to the rest of the market, the majors moved first, and the smaller producers are now sort of joining in as well. Other commodities, copper up slightly, crude up 25%, but off a very low base. So we're back up into the mid-20s at the moment, which is still way too low, caused by that situation where the futures market caused the price to actually go negative. So we're getting a rebound from that very unusual set of circumstances. And the global majors are progressing, and I'm not expecting them to go too far, but it was it really was a bit of a no-brainer that we'd perhaps get a 10 to 15% bounce in stocks like ExxonMobil or Woodside, etc. There's the spot copper chart. So just to wrap it up, and I'm really speaking here to those who are using the older, I'll call them the older practices of traditional investing. A lot has changed in a very short period of time, and there's a very strong possibility that it's not going back to the way that it used to be. So the question I want you to think about is, what are you missing out on if you cling to these old themes? If you think that owning the big four banks that are going to pay you a 5 or 6% dividend yield, or Telstra or AMP or whatever it is, but the traditional dividend paying stocks, and that all you care about is the dividend, you don't really care too much about the underlying, I think you really need to examine that methodology, because the question has to be asked: will the prices rebound? And if so, when will that occur? It could be quite a long time before that happens, if at all. And this is really the key point: what return could you be making while you wait? If you look at the price chart of stocks like in America, like the FANG stocks, or in Australia, a lot of the mid cap strong growth stocks, the returns there are simply stunning. So what return could you be making while you're waiting for that rebound? So it's not only just having the patience for the rebound, but it's what you're missing out along the way. And what if the traditional dividend stocks that I mentioned are forced to change their dividend paying policy? What if this is getting more towards a new normal and we don't go back to the old practices? This is a point that I've been talking about with members for a very, very long period of time, and that is Australia is a bit of an outlier in the fact that it pays out such a high degree of their profit as a dividend. A lot of these high dividend payers are paying out 65, 70, even 80% of their profit as a dividend. Now, I've always contended that if companies only paid out 30 or 40% of their profit as a dividend, and they reinvested that money back in growing the business faster, that everybody is better off. You end up with higher dividends in the future, and you certainly end up with substantial capital gain. But in Australia, we seem to have this set of circumstances where investors, and particularly large superannuation funds, put a lot of pressure on the boards of these big companies to pay out the highest dividend they possibly can. And what they're doing is they're robbing those companies of their ability to grow at a faster rate than they would. So I just think it's become ingrained in the Australian thinking that that's what they do. And in the same way that a lot of personal behaviours are going to have to change because of this virus and the lockdown, and that things aren't going to go back the way they were. A lot more people are going to work from home. A lot more people are going to do things very differently to the way that we did them in the past. And I just wonder whether a lot of these traditional dividend paying practices, this is going to be an opportunity for those companies to perhaps to snatch back the initiative and tell these fund managers that have been pressuring them for years to go take a hike and, perhaps retain more money for the growth of the business and the betterment of the business. So that's my bit of a soapbox rant this morning, but I think it's a very valid point to make. So a lot of these decades-old practices are being turned on their head, and I can assure you that not all of them are just going to go back the way they were. So something to think about for dividend investors. Okay, what are the main drivers of valuation? I'm almost done here. I'm sorry this is a long one, but I think these are really all important points today. The main drivers of valuations, it's a very complex set of things that go into valuing a company. But the main ones are future earnings and future cash flow estimates. And the second one is interest rates. They're the two really, really important ones. And at the moment, we've obviously got very, very low interest rates and almost no chance of those interest rates rising unless inflation just got completely out of control. And when it comes to future earnings and cash flows, then there are some parts of the market that are terrific. Growth stocks, technology growth stocks, and other areas that that have got enduring growth. And also, of course, the precious metals area as well. So focusing on those parts of the market that have got that future earnings and cash flow certainty, and don't worry too much about the PE, because at the interest rates we're at, the PEs are less important relative to history. So if you're fretting about the valuations of these market dominating companies, then stop it. It's just not necessary, and you're missing out on a golden opportunity. The leaders are leading for a reason, and the rest of the market shouldn't be getting your attention. And if you're thinking about trying to buy travel stocks or trying to buy airlines because they're so cheap, and I know that some people are, because I'm getting those questions in Portfolio Analyst. So I know that that discussion is out there. Well, you just got to stop doing that because it's too risky. Who knows when they'll rebound? So just go with the stocks that are running. Portfolio Analyst this week, be a 10-bagger update, and a lot of those stocks are really starting to motor now. They didn't do much in the first few weeks after the March 21 low, but they're really starting to build momentum now, and also the enduring stock portfolio update as well. So lots and lots of really good things happening. There's also some questions about portfolio rebalancing, which is important. So it'll be a big edition of Portfolio Analyst this week. That's it for this week. For those that want to find out some more, there's my website address. And if you wanted to communicate with me directly, there's my email address. That's it for this week. Cheers.